Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions, featuring the proprietary bull-bear point and figure market breadth summary chart for February 4th, 2018. Market breadth. With this past week's market decline, our bull-bear point and figure ratio at 0.75 fell from 1.74 last week, declining into bearish territory. The total count of securities in bullish or bearish patterns increased fractionally to 3,554. The count of bearish stocks increased 57%, while the count of stocks in bullish patterns decreased 32%. The Pirls PNF market breadth summary chart shows us a market now 1 week in bearish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the weekly Pirls Stock Market Commentary via email, free of charge, simply enter your name and your email address in the spaces provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 208 points for the 9th decline in 16 weeks. At a positive 238.39 points, it has fallen below the December 2016, February 2017, May 2016, and July 2017 highs, and below the 3 remaining tops in the last 30 months. And it continues above all 4 bottoms below minus 100 in the last 30 months. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in distribution mode, with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 4 accumulation days and 4 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week also, the Nasdaq ended in accumulation mode on higher average daily volume. Momentum. The CCI 20 daily in a Woody's uptrend is now at minus 21.86, 1 day below zero, down from a positive 126.39 last week. At Friday 12/29 close, the CCI 20 daily was within the plus or minus 50 range, presenting a zero line reject pivot point and long entry signal at Tuesday 1/2 open. At Tuesday 1:30 close, the CCI 20 fell below plus 100, signaling the end of our trade. The result of this trade simulation was a gain of 426.18 points on the Nasdaq, or $11.01 per share of QQQ. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 92 weeks ago, while the daily CCI 20 began a Woody's uptrend 22 weeks ago. The CCI 20 weekly at a positive 137.18 is down from a positive 193.44 last week, after forming a zero line reject long entry signal for Tuesday 9/5 open. Our rule is to stay in the trade until the CCI 20 drops below plus 100. We will continue to follow the result of this trade simulation in next week's commentary. Industry rotation the last 2 weeks. 2 of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: S&P Retail and KBW Bank on top. Oil Services, oil, and gold and silver on the bottom. Bullish: S&P Retail continues in the top 5. KBW Bank has entered the top 5. Oil Services continues in the bottom 5. Oil has entered the bottom 5. Brokers and networkers have left the bottom 5. Gold and silver has entered the bottom 5. Bearish: computer hardware, disk drives, and semis has left the top 5. Focus this week from www.realinvestmentadvice.com. Market Stumble or Something More by Lance Roberts. The following are some key points and charts. Never before in recent history has the market been this overbought and extended from longer-term averages, which suggests that a correction that reduces such conditions is highly likely in the near term. Well, this past week, the market tripped over its own feet after prices had created a massive extension above the 50 DMA as shown below. As I have previously warned, since that extension was so large, a correction just back to the moving average at this point will require a nearly 6% decline. I have also repeatedly written over the last year, quote, "The problem is that it has been so long since investors have even seen a 2 to 3% correction. A correction of 5% or more will feel much worse than it actually is, which will lead to emotionally driven mistakes," end quote. The question now, of course, is, do you buy the dip or run for the hills? Don't do either one yet. Yes, corrections do not feel good, but they are a part of a healthy market cycle. In more normal, healthy, bullish trends, corrections should be used as buying opportunities to increase exposure to equity risk in portfolios. However, the recent parabolic acceleration in the markets heading into the new year was neither normal nor healthy. Much of it had to do with the massive liquidity injection by the Federal Reserve at the end of 2017, as shown below. But after the stumble this past week, it will be interesting to watch the Fed's balance sheet over the next month to see if they continue with their planned $30 billion a month reduction. If the market rallies back and sets a new closing high, the bullish trend will be confirmed and equity allocations will remain at target levels and hedges removed. If the market rallies back but fails to set a new high, a series of actions will take place. At the point of rally failure, portfolio hedges will be modestly increased. If the subsequent decline breaks the previous low, the hedges will be further increased and tactical trading long positions will be reduced. Why is this important? A hint of 1987. A recent article on Zero Hedge discussing a view of Albert Edwards is salient to this discussion. Quote, "Certainly, as we explained at our conference, the current conjuncture feels similar to just before the 1987 equity crash. All that was missing was the slanging match over the weak dollar between the U.S. and Europe," end quote. He's right. There are many similarities between today and 1987. Recently passed tax legislation reform, exuberance in the markets, and a strong market rally, and then the crash. Despite a rampant rise in the markets, the recent spate of economic growth has been due to massive natural disasters across the lower third of the U.S. The impetus from those rebuilding efforts are now running their course, and we are already seeing a weakness in the numbers. But wages are crushing it, and employment is booming. Yes, wages are rising, but only for the top 20% of workers. And unemployment in the key demographic is not. The next bull market. There are several important points to understand about bonds. 1. All interest rates are relative. With more than $10 trillion in debt globally sporting negative interest rates, the assumption that rates in the U.S. are about to spike higher is likely wrong. Higher yields in U.S. debt attracts flows of capital from countries with negative yields, which push rates lower in the U.S., given the current push by central banks globally to suppress interest rates to keep nascent economic growth going. An eventual zero yield on U.S. debt is not unrealistic. 2. The coming budget deficit balloon. Given the lack of fiscal policy controls in Washington and promises of continued largesse in the future, the budget deficit is set to swell back to $1 trillion or more in the coming years. This will require more government bond issuance to fund future expenditures, which will be magnified during the next recessionary spat as tax revenue fails. 3. Central banks will continue to be a buyer of bonds to maintain the current status quo, but will become more aggressive buyers during the next recession. The next QE program by the Fed to offset the next economic recession will likely be $2 to $4 trillion, which will push the 10-year yield toward zero. The next bull market is coming. It just won't be in stocks. It will be in the U.S. Treasury market, which will coincide with the next recessionary drag in the economy within the next 12 to 18 months at most. Over the next several months, higher interest rates, if they remain elevated for long, will have a deleterious effect on the economy. Valuations will become problematic. Furthermore, the safety of bonds becomes much more attractive when the yield is significantly above the divided yield in stocks. Why take the risk in stocks for a sub 2% yield when I can get 3% in a U.S. Treasury? That's not hard math. Thank you for watching this week's Sand to Pirls Stock Market Commentary video featuring the proprietary Bull Bear Point and Figure Market Breadth Summary Chart compiled by Donald Pirl, www.s2pmarketsignal.com. Hoping that you have enjoyed a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.